Have you ever noticed something strange? When prices are crashing, people desperately want to sell. When prices are soaring, people desperately want to buy. The asset hasn't changed. The company hasn't changed. The economy may not have changed. But somehow, human behavior completely flips. And that raises an uncomfortable question. What if financial markets aren't just places where people invest? What if they're machines specifically designed to amplify human emotions? Because if you look closely, the market doesn't merely measure fear and greed. It feeds on them. Every day, trillions of dollars move around the world. Stocks, bonds, currencies, cryptocurrencies, commodities. Most people imagine these markets as giant calculators. Cold, rational, logical, a place where numbers determine outcomes. But that's not what actually happens. Markets are made of people. And people are emotional creatures, pretending to be rational, which means every market boom, every crash, every bubble, and every panic starts inside the human brain. And right now, understanding that may be more important than understanding any stock. Because the biggest risk in investing is usually not the market, it's the investor. Let's see why. Imagine it's the year 2020. A global pandemic shuts down economies. Businesses close. Airports empty. Entire cities stop moving. Fear spreads faster than the virus itself. Investors panic. Stocks collapse. Billions disappear. People rush to sell. They don't want profits anymore. They want safety. Then something unexpected happens. Governments step in. Central banks print enormous amounts of money. Interest rates fall. Liquidity floods the system. And suddenly, the market begins climbing. At first, nobody believes it. Then people get curious, then confident, then excited, then convinced prices can only go up. A few months earlier, people were terrified to buy. Now they are terrified to miss out. Same people, same market, completely different emotions. This is the first psychological hack. The market weaponizes social proof. Humans evolved in groups. For most of history, following the crowd increased survival. If everyone ran from danger, you ran too. If everyone found food, you followed. The instinct made sense. The problem is that markets exploit it. When prices rise, more people become interested. More interest attracts more buyers. More buyers push prices higher. Higher prices create headlines. Headlines attract even more people. The cycle feeds itself, not because value changed, because attention changed. Ironically, the higher the risk becomes, the safer it feels, because everyone else is doing it. And that is exactly when danger often begins. But social proof is only the first layer. The second layer is even more powerful: loss aversion. Researchers have found that people feel the pain of losses much more intensely than the pleasure of gains. Losing $1,000 hurts far more than gaining $1,000 feels good. Markets know this. Or more accurately, market participants create this effect together. Imagine your investment falls 20%. Your brain doesn't see percentages. It sees threat. Suddenly, every news article feels negative. Every chart looks worse. Every prediction sounds believable. The fear becomes emotional before it becomes logical. And once fear takes over, people stop asking whether an asset is worth owning. They start asking how quickly they can escape. This creates one of the strangest patterns in finance. People buy after assets become expensive, and sell after assets become cheap. Exactly backwards. Not because they're stupid, because they're human. Now here's where things become uncomfortable. Many industries benefit from this emotional cycle. Financial media needs attention. Attention often comes from urgency. Urgency often comes from emotion. A headline saying everything is fine rarely spreads. A headline saying markets in chaos spreads very quickly. Fear generates clicks. Greed generates clicks. Calm rarely generates clicks. As a result, investors are constantly surrounded by emotional signals. Breaking news, market alerts, predictions, warnings, expert opinions, most of which disappear a week later. Yet they shape decisions involving years of savings. Think about how absurd that is. A retirement plan designed for decades can be influenced by a headline written in 5 minutes. And that's not the only emotional trigger. There's also something called recency bias. Humans naturally assume the recent past predicts the future. If prices have been rising for months, we imagine they'll continue. If prices have been falling for months, we imagine they'll keep falling. Our brains struggle to separate trends from permanent reality. This explains why bubbles become bubbles. During every major mania, people convince themselves that this time is different. The technology is revolutionary. The opportunity is unique. The rules have changed. The story always changes. The psychology never does. In the late 1990s, it was internet stocks. In the 2000s, it was housing. In various periods, it has been commodities, cryptocurrencies, meme stocks, and countless other assets. Different assets, same emotional blueprint. Excitement, euphoria, confidence, overconfidence. Then reality arrives, and reality does not care about emotion. Markets eventually reconnect with fundamentals, sometimes slowly, sometimes violently. This is where the hidden math appears. Let's imagine an investor loses 50%. Many people assume they only need a 50% gain to recover. Not true. A 50% loss requires a 100% gain just to break even. That's the brutal arithmetic of emotional investing. Large mistakes create disproportionately large recoveries. And those mistakes often happen during moments of extreme emotion, not during calm periods. Now zoom out, because this isn't just about individuals. Entire economies can become emotional. Consumers become optimistic and spend more. Businesses expand. Banks lend aggressively. Investors take more risk. Growth accelerates. Then confidence weakens. Spending slows. Investment falls. Credit tightens. Fear spreads. The cycle reverses. Economic booms and busts are not purely psychological, but psychology acts like fuel. Sometimes a spark becomes a wildfire, because emotions spread faster than facts. And today, that process moves faster than ever. A rumor once took days to travel. Now it takes seconds. A single post can move markets. A viral video can influence millions. Algorithms reward engagement. Engagement rewards emotion. Emotion influences decisions. And decisions move money, which means the battle for investor attention has become more intense than at any point in history. The strange part is that none of this is hidden. The evidence is everywhere. The charts, the bubbles, the crashes, the headlines, the repeated mistakes. We keep watching the same movie, only the actors change. And maybe that's the biggest lesson. Financial markets are not machines that remove human emotion. They are giant systems that reveal it. Every trade contains a belief. Every bubble contains a story. Every crash contains a fear. Prices move because humans move. And humans are emotional creatures navigating uncertainty. The question isn't whether markets will continue hacking human emotions. They almost certainly will. The real question is this: if fear and greed are permanently built into the system, can anyone truly see the market clearly? Or are we all just reacting to